It is time for us to work on Lesson 4, a set of projected or budgeted financial statements. Here we're going to help a new startup company plan ahead as to what its revenues and expenditures are going to be, get an idea of what its cash is going to be, make sure they're not going to run out of cash, and if they're going to run out of cash, figure out where that cash is going to come from then. And so this is going to help this startup company project the next few years of its life. I give you some things to help get you going. So fixed asset purchases here. This is the equipment that the company is going to buy. You are going to help them calculate depreciation using the straight line method. Notice that in the third year you sell some fixed assets and buy some more. So don't forget that when you get in the third year. I also give you a loan amount, a loan from the bank. I give you the $50,000, the interest rate. It's a 2-year note. And I tell you that you are paying $1,500 per month. You do not need to calculate the payment. The payment is $1,500 per month. What you realize if you run an amortization schedule is that this loan isn't paid off at the end of the 2-year period. That's what a balloon payment is. It means that you have a final large balance that's still due, and it is due in full at the end of the 2-year period. Now, in real life, what many businesses do is they take that balloon payment and roll it into a new loan for a new set of years or whatever at a new interest rate. But we're not going to do that here. You're just going to go ahead and pay it off. Read the little comments in here, and then notice that I get you started, because there's nothing worse than looking at a blank sheet of paper in the beginning. Here is the first year. I give you the whole first year. Income starts at 0 because it's a startup company, builds up. We have a busy season, and then it starts dropping back down again for slow season. So these are your first numbers for year 1 of your 3-year projection. The only thing you need to figure out is depreciation and interest expense, and you can do that. So then if you figure out those two pieces, you have year 1 of your income statement done, and all you need to do is add 2 more years to it. Now when you add the 2 more years, you decide what your assumption of growth in sales is, or growth in expenses is. You pick it. What you want to do, though, is build enough flexibility in the system that if your boss doesn't like your assumption on growth, can the boss change it? So maybe you assumed revenues were going to grow 20% each year for the next 2 years. What if your boss doesn't like the 20%? Did you clearly and easily give them a way to change the 20% assumption to something else? I have a couple of other requirements in here. You can read those on your own. I'm going to give you an example of what one might look like. Here is an example of a set of financial statements. It's a 3-year projection with the accounts. And remember, I give you year 1, except for you've got to figure out those 2 items right there. So this is an example of what an income statement might look like. Notice that this person allowed me to come in and say, I want to project a growth rate of 50%, and once I enter that in, the growth automatically adjusted. Now, it didn't have to be 50% both years. The person gave me enough flexibility to say, well, it'll be 50% in the second year, and then it'll start slowing down. It'll only be 30% growth in the third year. But I can change that again too if I want. Okay. This particular person didn't let me change expenses by any particular amount. So it looks like those numbers were, they just automatically assumed 10%. And I don't know what that is. That one's flat. That was fixed. So they hard keyed some numbers in here. And I don't necessarily need so much flexibility as to change every one of these, but at least communicate over here on the side to your boss what your assumptions were. Some people have said, well, my wages and my payroll are related, so those are going to increase at the same amount. Everything else is just going to go up by 3% or something like that. Now, depreciation and interest, you can figure out exactly what those are going to be in the next 3 years. So those are not assumptions, those are calculated amounts that you can figure out based on the data that you have. Let's see, this particular person even gave me a macro that I could click and return it back to the original assumptions that they had put in here. That's kind of cool. What else do we have here? Now make sure that you give me your calculation of interest, so give me the backup to your amortization schedule, do your backup of how you calculated depreciation, so those should all be included in this file. This particular person has hyperlinks in here, so if I click on the hyperlink, it takes me to their calculation of depreciation. So some hyperlinks are great. I need 3 years income statement. I don't think I told you I need a statement of owner's equity. What did I say? Balance sheet, income statement, and statement of cash flows. Okay, so I don't actually require a statement of owner's equity, but it's certainly not a bad idea to do one because you need to know what your ending balances are anyway. You can certainly just slap an informal calculation of statement of owner's equity down here at the bottom of the income statement as well. That's actually pretty common, so that would be fine. I need a balance sheet. Now, for the balance sheet, you don't know cash yet until you do a statement of cash flows. So you can start creating a balance sheet because you know some of the numbers and you can fill those in. You know your loan and you can fill that in. Notice that there is a current portion of the note and a long-term portion of the note. So you can certainly fill in many of these numbers, and I would like you to make up an accounts payable number. You do not have to make up a supplies number. Making up an accounts payable number is truly the only number on this entire financial statement that you make up. Okay. Cash you will be able to fill in after you do your statement of owner's equity because that will tell you what your cash is. And then once you figure out your cash, you can slide it in here. I don't know that I have anything else major. I think with that, I'd like to let you go and see how you do. Take a crack at it. Remember that the more you can sketch out in Excel and kind of put in each of your accounts, even if you don't have a number for it yet, it will get your brain flowing. And then after you kind of get everything set up the way you think it needs to be and you get some numbers in there, show it to me in class or send me your file and I'll take a look at it and we can go from there with whatever questions or sticking points that you have.